So you have a bunch of adjusting entries, and this problem is asking you to figure out what happens to your financial statements if you did not do the adjusting entry. Okay, so it's giving you the first one as an example. So supplies on hand. So this is basically saying that your adjusting entry would have taken some supplies expense. So if you had not taken that supplies expense, which would have been, supplies expense debit, supplies credit, right? You're going to have your asset supplies overstated. And if you did not have this expense, you would have overstated your, see, this is wrong. This is actually expense. If you did not include the expense for supplies expense, you would have understated your total expenses, right? So this is trying to get you to see what would happen to your financial statements if you did not include the adjusting entry. If you overstate your assets and understate your expenses, that's going to lead to your equity balance being overstated. Why? Because equity, as we know, so equity, you're going to have contributed capital, you're going to have retained earnings. This is equal to your revenues minus your expenses minus dividends. So if you understate this, if you don't include enough expense, that means your retained earnings is going to be too high because your net income is going to be too high, which means your equity is going to be too high. It's going to be overstated. That's where this overstated comes from. So let's do a couple more. Accrued revenues. So again, accrued revenues means that you earned the revenue, but the cash is coming after. So what is the journal entry for that? If you earn revenue and the person's going to pay you later, what are you going to debit and what are you going to credit? Accounts receivable debit, service revenue credit. So if you do not have that, your balance sheet, your assets, are you going to have too little or too much assets if you did not debit accounts receivable? Too little. So you're going to understate your assets. Okay. What about your income statement? Let's just do that first, because then that will help us figure out the second part of this balance sheet. Is our revenues going to be too high or too low if we did not include that adjusting entry, which we just said was debit accounts receivable, credit service revenue? Too low. It's going to be understated. And if we understate revenue, it's the same thing here, okay? This is too low, meaning our net income is going to be too low, meaning our retained earnings is too low, which means our equity is going to be understated. Okay, so this is going to cause our equity to be understated. Okay, let's do this last one, E. Okay, unearned revenue that has been earned, 1,500. Okay, so what is unearned revenue? It's a liability. So if we don't do this journal entry that actually shows that we earned some of that unearned income, is that going to cause, what's that going to do? Is that going to affect our assets at all? No. What about our liabilities? Is it going to be over or understated? Overstated, yes. Overstated. What about our income statement? What's the effect? Understated our revenues, right? We're going to have our revenues understated because some of the revenues that would have been included, we didn't because we just left that liabilities too large. We didn't convert unearned revenue to revenue. So we would have understated the revenue, and that would cause our equity to be understated. Okay, so hopefully you're seeing this pattern. This one is conceptually tying together adjusting entries with the accounting equation. So you should understand this. You should be able to understand the meta of what I just did here, where if we don't include a certain revenue or expense, what that does to net income, how that affects retained earnings, and how that then affects equity. It's all kind of trickling up, you can say.